Friday, July 19th, 2019, Maneco 64, home of alternative economics and contrarian views. QE to infinity. I think it was Jim Sinclair who coined that term, or someone else. It wasn't me, but I always knew as well that there was a very high probability that central bankers around the world would never be able to get out of their unconventional policy since the '08 crisis. What was the unconventional policy? Well, money printing, zero interest rates, negative interest rates in some case, just irresponsible monetary policy not based on sound money. And how did I come up to that way of thinking? I came to that conclusion actually before the '08 crisis because I read this book here over 15 years ago, Fiat Money, Inflation in France, How It Came, What It Brought, and How It Ended by Andrew Dixon White, written in 1912. Andrew Dixon White, he was one of the founders of Cornell University and the president of Cornell University, and he was an ambassador, I think, to France as well, back in the 19th century. So with what's going on overnight about the Fed and the speech by the New York Fed president, I want to talk about that, how I came to that conclusion and why I think these central bankers are doomed and they're starting to lose credibility. Before that, of course, we'll have a quick look at what the markets are doing this morning. Yesterday was another very interesting day for precious metals. Gold actually broke out of the key resistance of 1440. I was surprised that it did that this early. We went all the way up to 1453 in the overnight session, late in the day in the States after COMEX opened again after the close. Silver as well has done very well. So it's 7:32 a.m. London. So let's quickly look at what the markets are doing. Right now, gold is off those highs. It had gone up to 1453 after the 5 p.m. COMEX open, or Project A as it used to be called. So right now we're at 1441, down about 4 overnight. The low has been 1438.59 and the high, as I said, 1453. I think this 1440 level now will be a support around here. It was the old resistance. As I've said, though, we're going to continue to see a lot of volatility in the precious metals. Just quickly show you a chart of gold, the daily chart. I had drawn this triangle or flag on the gold chart here a couple of days ago. I didn't expect it to break out as quickly, but it has, as you can see. So it's looking pretty good right now. Precious metals, gold and silver. Silver has been leading the way this week. So back to the prices. Silver is up 10 cents at 1643.45. The key level we broke through yesterday was around 1621, which was the high of this year. The high overnight has been 1648 and the low has been 1626. Stock market, yesterday, stock markets didn't do much, basically unchanged. The Dow, S&P was up a third and the NASDAQ up a quarter. So they didn't go down, but they didn't go up that much either. This morning we're a bit higher. The Dow is up 97 or 1/3% at 27,315. The S&P is up 8.5 or 1/4%, just above 3,000 at 3,002. The NASDAQ 100 is up almost 40 or 0.5% at 79.40. Currencies, the pound is down 0.2%, 125.21. Yesterday it rallied quite a bit, almost 1%. On news of Brexit, the fact that MPs voted to take no deal Brexit off the table. Euro is down 0.13%, 112.62, and the dollar is up 0.33% at 107.67. Dollar yuan unchanged, 687.60. Crude oil, WTI is up 50 cents, or just under 1% at 55.90. Brent crude is up over 1%, or 75 cents at 62.50. Bond market, well, the 10-year yield is at 204, so pretty much unchanged. But what we've seen here is that the 3-month has dropped quite a bit. We're now at 204 as well. So the curve is basically flat. That was on news yesterday that the Fed might be more aggressive on rate cuts coming up this month. The FOMC meeting starts on the 30th and ends on the 31st. They should announce on the 31st. So QE to infinity. Why am I being arrogant saying I knew this would happen? No, I think it's the case of trying to learn from history and realize that history doesn't repeat itself perfectly, but it rhymes. And basically, this is the story of France during the revolution, the French Revolution. In the aftermath of the French Revolution, the French state was bankrupt. It had loads of debt. The economy was stagnant. Things weren't great, so they had to. They decided, the French National Assembly at the time decided to embark on an experiment of paper money, that they called it at the time, or fiat money, as Andrew Dixon White calls. And they were called the assignats. And they're very, everyone is very skeptical about it. They didn't do it very willingly. They had a lot of debate about it, and they backed these assignats actually with church land and property that they confiscated during the revolution. So it was actually backed by something. And the idea was that they only needed one issue of these assignats, and that it would kickstart the economy, just like they talk about these days. You know, we need a little bit of QE to kickstart the economy, get the ball rolling. And the problem back then, and the problem now as well, I would say, is that once you go down this road, you can't stop. And why do I say that? Well, because they tried to stop in France, but every time they stopped, the economy would implode again, and they have to start again. And every new issue had to be bigger and bigger. And eventually, around 1796, everything had imploded. You had hyperinflation. The other thing that you get under this regime of fiat money or fiat currency or inflation and easy credit is that you get authoritarianism. You get the government trying to control things because it doesn't work. They try to control prices, and if people don't abide by the rules, they get imprisoned or even executed, in this case in France. So it just ends in tears, and it did. They ended up burning the printing press at the Place de Vendôme in Paris. I think it was in 1796. So it took about just over 5 years, this experiment in France, and it failed. I know the experiment now is worldwide. It's not just one country. That's why it's taking longer to fail, I think. And it started about 11 years ago or 10 years ago. But I think we're going down the same road. And that's why the Fed was unable to normalize their monetary policy, which they tried. They tried to QT, or let their balance sheet, shrink. They started raising interest rates, but they saw that everything was going to implode. The stock market was going to crash. So they're back at it now, saying that they're going to do it again. And they're losing credibility as well. And I'll come to that in a second. So that's how I came to this conclusion, by reading this book. And when they started out this policy in 08, 09, or just 09 and 10, I knew then that it would be QE to infinity. I didn't use that term, of course, but that's a good term. You know, I told people they're not gonna be able to stop it, and it's gonna get worse and worse, and they're gonna keep doubling down. They're gonna keep printing. They're gonna keep cutting rates, and it's not gonna help. It's only gonna help the very rich, the people involved in finance, and it was the same thing in France back in over 200 years ago. It's amazing. So yesterday, we had a speech by the New York Fed president, and actually they're losing credibility. And why do I say that? Well, there's an article this morning. I woke up and I saw this in the FT. It says, New York Fed takes unusual step of clarifying president's speech. Bank comments after John Williams' remarks stoke expectations of aggressive rate cut. So they had to even come out and say, you know, he was just talking about academics. He wasn't talking about what we're experiencing now. But I'm not too sure. I think they were just maybe unhappy with the way things went, and they just. But it just goes to show this is very rare. So I'll just quickly go through this article. It says here, the Federal Reserve Bank of New York took the unusual step of clarifying a speech by its president, John Williams, after his remarks stoked expectations of aggressive interest rate cuts by policymakers. Mr. Williams on Thursday laid out the case for early monetary easing in the low interest rate environment, likening it to a vaccination for children against illness down the road. These guys are getting really desperate. And I quote him, he says, it's better to deal with the short-term pain of a shot than to take the risk that they'll contract the disease later on, he said. How can he consider a cut in interest rates or more money printing short-term pain? I would say that it's the other way around. A rate hike and quantitative tightening would be short-term pain. This is just ridiculous, I would say. What do you think? Comment below. The remarks led markets and some economists to increase their bets that the Federal Open Market Committee would cut interest rates by 50 basis points when it meets later this month, rather than the 25 basis points that were previously forecast. Later, however, New York Fed spokeswoman cautioned against reading too much into the comments by Mr. Williams. This is what the New York People said, and I quote, "This was an academic speech on 20 years of research. It was not about potential policy actions at the upcoming FOMC meeting." I'm not too sure about that. The guidance by the New York Fed highlights the Federal Reserve's struggle to contain market expectations with regard to the scale and timing of monetary easing. The U.S. Central Bank risks losing flexibility if investors are aggressively banking on a substantial loosening of monetary policy. I would say they're also losing credibility. During his speech, the New York Fed chief said policymakers should not keep their powder dry to preserve space for easing only after there was more hard evidence of a downturn. And this is what Williams said. When you only have so much stimulus at your disposal, it pays to act quickly to lower rates at first signs of economic distress, Williams said. The remark sent yields on U.S. Treasury bonds falling. The yield on benchmark 10 years fell 4 basis points to 203. So while the U.S. yield on the 2-year bond fell 8 basis points to 176. So we're now at 204. It hasn't really come back up that much. Where is the 2-year now? It's up a little bit. It's at 179. But so the article is saying that the market has kind of priced back the expectations to 40% at the end of the month from a 66% chance after the speech. But in my opinion, the importance of this is that the Fed is losing credibility. They're using some really spurious arguments. these Fed officials to say that it's short-term pain to cut rates. I mean, that's just ridiculous in my opinion. So I highly recommend, if you haven't read this yet, to read this book. There are free PDFs online, Fiat Money, Inflation in France, and really great book. It's less than 70 pages. You could probably read it in an afternoon. And it's one of the books, even though it's very short, that really helped me understand the nature of money, central banking, monetary policy. If you enjoyed this video, make sure you hit the like button. Make sure you also share this video far and wide with people you think might enjoy this kind of content. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.